I am Davis Blaine, chairman of Mentor Securities, a middle market investment bank. We provide services to help companies sell, to help companies buy other target companies, and provide also growth capital and exit planning. Exit planning is key to getting a company ready for a sale. This video is the first in a series on selling a company. Our YouTube channel is the M&A Corner Office. And so we would like you to like, share, and subscribe to our YouTube channel. This first video is going to cover the initial meeting with a prospect. And to give you more background, this is a prospect who we know a little bit about, but they have not yet sent us their financials. So we're going to dig deep into information that we can gather. This first meeting with a prospect is really critical because we get to assess one another and see if we want to do business. We can make sure that the seller who says they want to sell is totally committed to the process, and also that they really understand all the nuances of the process. And we gather enough information from this first meeting to come back with a second meeting where we can talk specifically about adjusted EBITDA, which is earnings before interest, taxes, depreciation, and amortization. We can talk about a range of multiples for the business, and we can also identify and talk about significant issues that the buyers might want to push back on in terms of reducing price. So we need to attack those issues and be able to answer those as we go through the process. So I want to introduce our professionals with the Mentor Securities. First is Rhett Plotner, who has sold and bought many businesses and also has a career operating companies. Second is Gary Lotzer, who likewise has sold many businesses, has helped companies buy business, has raised capital, and has operated businesses, both private and public. So let's jump in. In terms of the business, how do we make sure that this business is really committed to selling? Other than asking the question, Gary, you want to tackle that?
Sure. Well, asking about their level of interest with regard to actually selling the business may provoke some opportunities to ask some other questions about that, such as, do you have an exit planning window? Do you have an idea of what the future trajectory of the company is going to be, which would impact valuation? Have you talked to any prospects, or have you been approached by any prospects?
Okay.
What is the timeline you have in mind?
Okay. I think that response or that question of asking about, have you been approached by people and do you have specific prospects, is a very good one, because it'll help identify that commitment, and it also tells us what the playing field is. Rhett, what else about the business might we want to explore in this first meeting?
About the business itself or the seller's motivation?
Either one.
Well, as far as the seller's motivation, beyond being approached, is if they're truly ready to step away. That might mean retirement. If it's retirement and the family doesn't want to take over, then they're obligated to look for exit opportunities in that fashion. What sort of plans they have for afterwards to determine if they really are looking to sell.
And part of that, Rhett, too, is if they want to stay on, or if the buyer wants them to stay on for a certain period, is that acceptable to them? So they need to think through what they want to do after they make the sale, right?
Yeah, and many times in certain situations, that's often the case, where the buyer does want the seller to remain on post-transaction, especially in smaller businesses or sort of niche businesses where the seller has a plethora of information that they learned throughout the years of operating the business that won't necessarily translate immediately to the new management team. That's all something that a buyer will consider and want to make part of the offer to buy the business.
Got it. And Gary, how do we elicit the right information? We need to dig deep into this company. Are their financials in good shape? What are their metrics? Do they know the cost of sales? Do they know their margins? So these are the types of questions that we need to pursue, right?
Yes, at this juncture, as you mentioned, Davis, we haven't actually been provided financial statements
Right.
in their entirety. And so for purposes of just discussing seller considerations, we might just ask some simple questions, which also would test their spontaneous knowledge as to certain metrics of the company, such as, what is the revenue trend the past 3 to 5 years? How do you expect the revenue trend to change over the next 3 to 5 years? Same thing with your margins and your EBITDA. Are you anticipating that any major capital expenditures will be required to be able to fund the business plan for the next 3 to 5 years?
That's a very key point. Also, competitors. Who are their competitors? Where do they stand within their industry? Right? Because that's critical. Because if you're selling the number one or two company in their market niche, you're going to get much better pricing than if there are 4 or 5 competitors that are ahead of them that they're always fighting with, right? Because that becomes a price issue. So, Rhett,
Yeah,
what?
there's
Yeah,
wisdom in the saying, knowing your numbers. I think knowing your numbers and the projections and the outlook is more important than perfecting the numbers or making them ideal in your eyes to what the ideal would be for a potential buyer. Because many times, especially with private buyers, they're looking for opportunities to improve the business
right.
after the purchase so that they can make money on their investment. So it's not necessarily about perfecting the numbers, it's knowing them and to be able to convey them with confidence and having your ducks in a row.
Yeah, exactly. Because if the numbers don't add up or the numbers are a little off, that really freaks buyers. They want to make sure your financials are up to date. I guess along that line, one of the important things would be to ask who their advisors are. We may not know their advisors, or we may know their advisors, but I think it's good to know their corporate attorney. Do they have an M&A attorney, or do they have one attorney who can handle both? Who's their CPA? Do they get audits? Do they get reviews? And sometimes we can glean a lot of information just if we know who their outside professionals are. What do you think, Gary?
I think that's absolutely important to have on the agenda for that dialogue with the seller, and at the same time, maybe ask about to what extent the seller's management team is going to be committed to the transition process.
Yeah, yeah, exactly. And do we need to bring in other advisors potentially, right? Or do we need to at least think about that? Because sometimes if they've never gone through this process, they may have a corporate attorney who incorporated them, but he's never done a deal. And that can be a huge impediment if you don't have the right, transactional attorney who's gone through this. So I guess the other thing we want to make sure is that, have they really thought through and talked to their family about what this looks like after the sale? Because sometimes family members can get in the way, and sometimes they're extremely helpful to the business owner to let them think about something that they haven't thought about before. And that is, who am I? What do I want? What do I want to do after the fact? But I think the other question to ask Gary might be, do they have a business plan? Because, Rhett alluded to the fact about not perfecting the numbers, but the business plan will tell us what those projections look like. Are they making budget projections?
Business plans are critical, and too often they are absent from the information that guides the company going forward. And even with a well-written business plan, it needs to be an actionable business plan with milestones that would tie the milestones to the revenue projections and objectives on even a weekly, if not monthly basis.
And Rhett, I know you have a lot of experience in this area. Wouldn't we want to ask what those value drivers are? What is their, I mean, most companies have intellectual property today. So we want to know what that intellectual property is. Do they really own it? Are they licensing it? And how much value does that help create for the business?
Certainly, the valuation, especially around IP, is critical, even in the early stages. That might be where many folks choose to start out when exploring an exit opportunity is, what is my company worth? And that's
Right.
a process and an exercise in and of itself, and can often be a very good cornerstone of a successful M&A transaction, because we know where we stand from the beginning. We know what information we have and don't have and will need to facilitate a smooth and efficient process.
Yeah, and we want to get to that point quickly because we want to know what is their line in the sand? What do they think they want to get for value? And so, our process is we get a retainer, and then we have a transaction fee. And as part of that retainer or advisory fee, we will do a valuation, an analysis of value, because when we sign off on an agreement, we want to know what we're targeting for. We want to know that the seller is going to be comfortable with that price. Okay. Obviously, our idea is to go to the marketplace and try to get a higher price. But it's really important to have that basic agreement with the seller going in. Don't you think, Gary?
Absolutely, and it basically is an important baseline,
Mm-hmm.
and at the same, to have mutual understanding as to what the expectations are, and which therefore helps to preset the seller's expectations so that when we bring a deal to the table that fits that baseline or doesn't, we're prepared to address the positives and the negatives.
Right. Well, I think coming back to the second meeting when we have enough data, we can probably have at least a top level discussion about what the range of multiples would be, what their adjusted EBITDA might be. So we can kind of start putting our arms around value. But I think, Rhett, your point is well taken, that really we need to, even after that point, as part of being retained, we do more in-depth analysis to really find out what this business is worth, because that's where we uncover more of the issues, hopefully mostly positive, but there's always negatives that we need to encounter and get past as part of our due diligence, right?
Always.
Okay. Well, guys, I appreciate it. I think we can wrap on this first session of approaching the prospect, trying to find out as much information as we can. What are the key issues? And then once we know that, we can go back to the second meeting, which will be part of our video series. And I appreciate us getting together and talking about how to sell your business. And we'll be on YouTube channel, which is the M&A Corner Office.